Hello, my name is Benjamin Lopez, and today we're going to be answering the question of how fintech might impact the mission of the Bank of England. And in order to answer this question, we need to clarify what the mission actually is, and it's to promote the good of the people of the UK by maintaining monetary and financial stability. I'll be answering this question by looking at the artificial intelligence and its application in central banking. I'll introduce the ideas of integrating blockchain and CBDC into central banking as well, and the potential kind of challenges that come along with that. Then I'll discuss the solutions to those problems, and I'll conclude with the recommendations that I've discovered through creating this presentation. One example of a fintech tool is the blockchain. And so what is the blockchain? Well, it's a digital ledger that has many of its copies, thousands of its copies, widely distributed across the world. It's a platform where consumers can send or receive their money, like electronic money, and it essentially facilitates the money transfer process so that third parties such as commercial banks become obsolete. Blockchain is more secure, boasting cryptography, security levels, proof of work security levels, and of course peer-to-peer monitoring. The transaction times are much quicker than traditional banks, whereas a commercial bank might typically say a transaction can take up to 7 days to complete. The average completion time on blockchain is about 10 seconds. Finally, there's lower kind of costs associated with CBDCs in the blockchain, which means that prices are a lot lower compared to commercial banking. Of course, in order to make the blockchain actually work, then we need those digital currencies that we were talking about. And so that's when CBDCs come into play. A CBDC stands for a central banking digital currency. And so the introduction of a CBDC would mean that it's a legal kind of tender, still part of the fiat system. So if this were to happen, then this would essentially shift us into a kind of cashless society, and that comes with its own benefits. According to the BIS annual economic report of 2021, the CBDCs offer the opportunity to be created with kind of the public interest in mind. And so it gives an example of instant retail payment systems by which creating an open payment system, the bank could create a more competitive level playing field. And of course, in doing that, it would create a kind of environment for innovation to grow. So also moving on, according to the Reserve Bank of India, central banks also stand to gain higher seigniorage due to lower transaction costs associated with the CBDCs. Finally, integrating a blockchain system can reduce tax avoidance and crime because of the nature of transparency within the blockchain system. However, the shift does present some risks that needs to be managed properly by the bank. The blockchain integration could make fee-dependent commercial banks obsolete and eventually make them bankrupt. This could lead to a run on the bank. This, of course, goes against the mission of the bank and is creating financial instability. Also, the influx of users, which are more concerned with their fiscal health than their data, might lead hackers to kind of take advantage of this and hunt for their data. Data is protected using cryptogram technology and making contactless payments, but of course, data needs to be protected at storage as well as when making payments. We can tackle the first one, and we can kind of say that the Bank of England needs to create regulations that eases the transition from traditional banking or commercial banking systems to the blockchain system in a way that leaves enough room and allows these commercial banks to adapt so that the consumer won't suffer if the banks go bust. Using a blockchain system, of course, means that transactions are transparent, which serve as as a part of the collective security. This blockchain system offers the broader risk framework that Hahnhofer calls for. The recommendation of this review is to integrate new forms of fintech such as the blockchain system and CBDCs into our central banking system. It also it's also to kind of integrate machine learning with the blockchain system in order to play a larger role in key central bank functions. These functions include creating and adjusting monetary policies and analyzing data gathered from the blockchain.